In November 2022, the third largest cryptocurrency exchange in the world collapsed in 10 days, vaporizing $8 billion of customer money. Its founder had been photographed with presidents, celebrities, and the most powerful investors in finance. He testified before Congress about crypto regulation. He was called the next Warren Buffett. He was 28 years old, and almost everything he had built was a lie. This is the story of Sam Bankman-Fried and FTX. Bankman-Fried, known widely as SBF, founded the trading firm Alameda Research in 2017, then launched the cryptocurrency exchange FTX in 2019. FTX let users buy, sell and trade cryptocurrencies, and it grew explosively, eventually becoming the third largest crypto exchange globally, processing billions of dollars in daily trading volume. SBF cultivated a very specific public image: disheveled hair, t-shirts and shorts even in formal settings, an old Toyota Corolla despite his billions, and a public commitment to something called effective altruism, the idea that he was making money specifically to give enormous amounts of it away to help humanity. He testified before the United States Congress about cryptocurrency regulation. He donated tens of millions of dollars to political campaigns. He appeared on magazine covers. At its peak, FTX was valued at $32 billion, and Bankman-Fried personally was worth an estimated $26 billion on paper. The fundamental problem, hidden from regulators, investors and customers, was the relationship between FTX and Alameda Research. Customer funds deposited on FTX, money that users believed was simply being held for trading on the exchange, were being secretly funneled to Alameda Research. The trading firm Bankman-Fried also controlled. Alameda used these customer funds for risky trading bets, venture investments, political donations and lavish spending, including a $100 million luxury real estate portfolio in the Bahamas where FTX was headquartered. This was a direct violation of how an exchange is supposed to operate. Customer deposits are supposed to be segregated and protected, not used as a piggy bank for a sister company's trading activities. On November 2, 2022, the crypto news outlet CoinDesk published a leaked balance sheet showing that a massive portion of Alameda Research's assets consisted of FTT, a token created by FTX itself, essentially monopoly money that FTX had simply printed and assigned value to. This revealed that Alameda's financial health was built on an asset with no real independent value. Changpeng Zhao, CEO of rival exchange Binance, which held a large amount of FTT from an earlier investment in FTX, announced on Twitter that Binance would sell off its entire FTT holdings, citing recent revelations. This triggered a panic. Customers raced to withdraw their funds from FTX, fearing the exchange was insolvent. Within 72 hours, FTX faced $6 billion in withdrawal requests, and it became clear the company simply did not have the money. The funds had been spent, lost in risky trades, or were illiquid investments that could not be sold quickly. On November 11, 2022, just 9 days after the CoinDesk report, FTX filed for bankruptcy. Sam Bankman-Fried resigned as CEO. Investigators discovered that customer funds, money belonging to ordinary people who had simply deposited cryptocurrency on the platform, had been commingled with Alameda's funds and largely spent. Estimates of the shortfall ranged from $8 billion upward. On December 12, 2022, Bankman-Fried was arrested in the Bahamas at the request of United States authorities and extradited to face charges including wire fraud, securities fraud, and conspiracy to commit money laundering. His trial began in October 2023 in New York. Several of his closest associates, including Caroline Ellison, the CEO of Alameda Research, and Bankman-Fried's former romantic partner, testified against him as part of plea deals, describing how customer funds were knowingly diverted and how financial records were manipulated to conceal the true state of the company's finances. On November 2, 2023, after less than 5 hours of jury deliberation, Bankman-Fried was found guilty on all 7 counts against him. On March 28, 2024, Judge Lewis Kaplan sentenced Sam Bankman-Fried to 25 years in federal prison. The judge stated that Bankman-Fried had shown no genuine remorse and had been willing to lie under oath during his own testimony. Remarkably, bankruptcy proceedings later determined that most FTX customers would eventually recover the dollar value of their original deposits due to the rise in cryptocurrency prices after the collapse, though this took years of litigation and offered no comfort regarding the underlying fraud. The FTX collapse remains one of the largest financial frauds in American history, notable not for complexity. The scheme was relatively simple. Customer money was just used as if it belonged to the founder, but for how completely the financial world's gatekeepers, venture capital firms, due diligence teams, and even federal regulators failed to catch it, dazzled by a young founder who looked nothing like the Wall Street villains they expected fraud to come from.